So the grayish patches, the shaded areas in gray are the recessions then followed. But we can see it happening again. By the way, not only do we have an uninversion, the yield curve, there is a chart which I showed back in the summer, which showed an increase in the unemployment figures. And according to the dowtheory.com, that also supports a recession. There's a divergence. So Dow 30 makes a new high, as it did recently, post-election, but the advanced decline line made a lower high.
If you've got your index still up there, but you've got a advanced decline is diverging, and also you're seeing divergences in that you're seeing that a fewer percentage of stocks trading above their respective 50-day moving averages and hundreds, then that's a divergence as well. At the end of the day, the S&P, statistically, yes, going into the end of the year, between the end of an election and the end of the year, usually does on average historically 3%.
All right, guys, hello and welcome. We're joined here today by my good friend and trader Charlie Burton of charlieburtontrading.com. This should be an interesting video because I'm going to ask Charlie's opinion about these specific charts, which are giving strong warnings to the stock market. For example, this chart, which warns about a potential recession, and these two charts, which are showing divergences, potential warnings for the stock markets. What do they mean for the stock markets as we head into the new year, 2025, and also as we close the year in 2024? Should be quite interesting, guys. Join us. All right, guys, welcome back. So how are you doing, Charlie? You well?
I'm good. Yeah. Loving this UK weather at the moment. Just this lovely autumn dullness. Yeah. Where's the sun
I don't know if
gone?
you're being sarcastic or you're being
I'm being
serious.
very sarcastic. Yeah.
Yeah, it has gotten very cold in the UK.
I'm looking forward to Christmas lights are going up, aren't they, in the
Yeah.
shopping centres in London and all around the world.
Actually, before we go on to the first chart I want to talk about, Charlie, I do have to make a correction, which in a previous video that I did with you, in a previous interview that I did with you, I mistakenly said that obviously I got the whole election result wrong. So I said that based on the stock market action and the stock market behavior was saying that Harris was going to win the election. But I also made a mistake by saying that Socionomics was saying that Harris was going to win. That actually was incorrect. In the video interview that I did with Bob Prechter, he correctly said that the statistics and historical methods show that there is absolutely no correlation. There's no correlation between the stock market and when a vice president is running for an election. And Bob actually was right in saying that the historical results and the statistics does not show any socioeconomic correlation between the stock market and the election result.
We found absolutely no reliable statistical correlation at all.
I actually, what I meant to say was that the stock market being in an uptrend, that favored the incumbent. That's all I was trying to say. But certainly it was not socionomics. It had nothing to do with socionomics. So I apologize about that. I apologize to you guys and also apologize to Bob. Charlie, this is an interesting chart. This is one of the biggest warning signs for the stock market. This chart is courtesy of LED Wave International. And what it shows is that the great uninversion in the yield curves has occurred. In other words, the uninversion of the 2-year minus 10-year yield curves. And whenever this uninversion has occurred in the yield curves, we've seen recessions then follow. Doesn't mean a recession has to follow immediately. Sometimes it takes a year or two. But if you look at the past history, this was an uninversion yield curve back in the 70s, which was then followed by a recession there. Then there was one here in the 90s. Uninversion, the yield curve there, followed by the 90s recession, as we can see in gray. So the grayish patches, the shaded areas in gray are the recessions then followed. There was one obviously in the early 2000s, dot-com crash, and then the recession that followed. That was the yield curve uninversion there. There is the uninversion, the yield curve in the late 2000, 2007, 2008, which was then followed by the Great Recession, shown in gray here, 2007, 2008. And of course, the more recent one that occurred, was that 2020? I think it must have been the 2020.
Looks like it's suggesting on there about 2018. I don't think if it was, I think from what I remember, there was like it was a really short recession. Well, there was a short recession in 2020, but that looks on your chart there. It was showing it as it before.
Yeah.
If there was a recession, then it didn't make any difference to the stock market, so we have to be wary of that.
Yeah, exactly. I mean, there was an uninversion of yield curve just before the mini recession that we had. That was the COVID crash, and the mini. I say mini was a temporary recession, where there's a mass unemployment as well. in the year 2020. That was a very quick recovery, by the way, as well. But we can see it happening again. By the way, not only do we have an uninversion the yield curve, there is a chart which I showed back in the summer, which showed an increase in the unemployment figures. And according to the dowtheory.com and my friend Manuel Bly, that also supports a recession likely in the next year or two. But anyway, we have an uninversion the yield curve happened recently, which does warn of a recession potentially in the next, maybe the next year or two. So this is the next chart I want to show you. By the way, guys, before we continue, I just want to quickly mention this before I forget. If you haven't yet checked out Charlie Burton's great trading service, go and check out Charlie's gold level membership on this link you see here. It's in the description. Apply the promo code LTGold and get a nice discount. The price drops down to £1, which is approximately $1.30. So go ahead and check it out. Do you look at market breadth at all, Charlie? Because this is the next chart I want to talk about. And this is the advanced decline line, market breadth. Actually, for people who don't know, for folks who may not be aware of market breadth, can you explain what that is, how you would apply it to the charts?
Market breadth is a breadth indicator. So what it's looking at is it's looking at a cluster of what a cluster of stocks are doing on the New York Stock Exchange. So although the Dow, in this instance here, that's only 30 stocks, whereas the New York Stock Exchange shows thousands of stocks. And so it gives us a better indication of how they are getting on. So you might have a headline index like the Dow or even the S&P, but there are only 30 stocks or 500 stocks, whereas the New York Stock Exchange is a few thousand. So it gives us a better breadth of what a wider variety of stocks are doing. So that's one breadth indicator. And something else is an easy breadth indicator to use is just the percentage of stocks on the New York Stock Exchange which are trading above their 50-day moving averages or their 200-day moving averages. That's a breadth indicator as well, because quite often you'll see the index pushing higher because a few really big stocks are dragging the indexes higher, such as these days the Magnificent Seven, for example. But actually, there's fewer of the wider spectrum of stocks are participating in that rally, and that's how you get these divergences, and that's what we call a breadth divergence.
Yeah, I've often compared this to the health of a car as well, like opening the bonnet of a car and looking inside the engine of a car, seeing everything is healthy and running okay, similar to what we're seeing underneath, what's going underneath the markets. Okay, so Charlie, we have here a chart of the Dow 30 against the advanced decline line. There's a divergence. So Dow 30 makes a new high, as it did recently, post-election, but the advanced decline line made a lower high. And that's important because it's a warning sign. But by the way, the same thing happened. Let me show you this. The same thing happened on the S&P. S&P rallied, made a new high to 6,000. And then the S&P pulled back, the pullback which we expected. But we also have a divergence. So a higher high with the S&P, but the lower high on the advanced decline line. And the reason why this matters, for people who are wondering, well, why does it matter? Because usually before a market top occurs, before the stock market tops, usually there's a divergence on the advanced decline line, a negative divergence like we're seeing here. Now, I want to be clear about this. This data does not mean the market's about to top. Okay, so I'm not saying that just because we have a divergence, a negative divergence on the advanced decline line, that we have definitely a top in the stock market. No, no, no. The market has to do a lot more work before we can even say there's a top. For example, if the stock market were to drop below support, so I'm not saying it's going to happen, but if the stock market were to drop in a strong fashion below the October and the September lows, then the odds would increase of a potential top in the stock market. But we're not seeing that at the moment, okay? And actually, I want to talk with Charlie about this. I still think despite these divergences, the market has a potential, probably by the end of this year, to make a new high, new all-time highs to the upper 6,000s, potentially above the 6,000 level. There is that potential because the Christmas rally and the Santa Claus rally by the end of the year. But we do have to mention these warning signs because in the past, for example, before the dot-com crash, the 2000 recession and the dot-com crash, there was a divergence in the advanced decline line. And before the Great Recession occurred, before the 2007 top occurred, there was also a divergence in the advanced decline line. Similar to what we're seeing here, although this divergence is not as bad as the previous divergences we've seen in the past. But it's a divergence we have to look at. It's a warning sign we have to look at. So what do you think? What do you make of all that, Charlie? What's your view?
Well, they're all. It's always interesting to see, when we see divergences like that in the markets. And so, what I like to see is overlaps. So, if I see a divergence in whatever it is, let's take the advanced decline line like that, then I'll be looking out, well, for other divergences or other signs which are, adding to that story. So, I won't ever take a single thing. I would look for confluence and
Yeah.
overlaps with other signs.
Can you just give us a very simple example of what other sign you'd be looking at?
Well, something like the percentage of stocks trading above their respective 200-day moving averages, 50-day moving averages. That's another breadth
Good point.
signal, because if you've got your index still up there, but you've got a advanced decline is diverging, and also you're seeing divergences in that you're seeing that a fewer percentage of stocks trading above their respective 50-day moving averages and hundreds, then that's a divergence as well. And then you can also have a technical chart divergence using an RSI or an MACD or what,
Yeah.
that type of divergence indicator. So then, and ideally into a key resistance level as well. So then you're
Yeah.
starting to build a technical backdrop there, looking at more than just one thing.
People often say, well, look, Alessio, in your last video that you did with Charlie, both of you were quite bullish on the stock market for the remainder of this year. So why are you putting out a video like this where it sounds quite bearish, with warning signs? Guys, it would be a mistake for any analyst not to look at potential perspectives that go against his major view. So even though I'm still bullish for the remainder of this year, going into the end of the year, going to January, I still think we have another push higher to go above 6,000. Again, on the balance of probabilities, not a certainty, but I think that's more probable. It's very important to examine the other side as well, because we could be wrong. A trader or an analyst who never looks at the potential risks, at the warning signs, I think they would be doing themselves an injustice. Charlie, do you agree with me on this? I think somebody an analyst who never looks at risk, who never looks at the warning signs or anything that might go against his view, I think that would be wrong.
Price is king, right? And
Yeah,
so when I was last on with you, the S&P hadn't got to 6,000 at that point. So we were
yeah,
talking about it getting to 6,000. And so it's got to 6,000. So fine. And if it had carried on piling through, fine.
yeah,
But it has reacted there so far. And so we have to look at what price is doing, because that's
yeah,
everything, price. And
yeah,
so, yes, we have to at least consider both sides of the argument, so to speak. So, and the end of the day, the S&P, statistically, yes, going into the end of the year, between the end of an election and the end of
yeah.
the year, usually does on average, historically, 3%. Well, it's already done 5%. So
Mm.
it's already more than done that. It's not to say that it can't go all the way back up and breach 6,000 again, but we have to look at both sides there.
So we're seeing at the moment a pullback, which was expected. We were looking at this. In fact, in the member videos and previous videos, we talked about a pullback in the S&P and the stock market. Do you think once this pullback is out of the way, we could see at least another push higher, another all-time high, new high by the end of this year, at least by the end of Christmas, perhaps going to the new year? Do you see that on the more likely or less
It's
likely?
certainly possible. It's certainly possible, because the
Mm,
history is on
mm.
its side for a Santa Claus rally.
Yeah,
It's just that they've already done, like I've just said, already had a really good run post the election. But history still says, well, December we should get a Santa Claus rally. So I guess it
mm,
depends on how much we pull back. If we pull back just a bit too deep, then it may be a
mm.
bit harder to get up there in the next 6 weeks. But if the pullback that we're seeing at the moment remains relatively shallow, maybe we pull back a little bit more, then certainly don't write off the history books. No.
Yeah, absolutely. I mean, we still have an uptrend. I would say the uptrend is in place on the stock markets, provided we stay above the trend line and provided we stay above the September and October lows. So I'm going to remain a cautious bull on the stock market. I'm remaining cautiously bullish on the stock market, regardless of any pullbacks. I mean, there could be pullbacks and glitches between now and the next few weeks as we head towards Christmas. But I think as long as the S&P protects and stay above the September, October lows, the odds are higher for the uptrend to continue to higher levels by the end of the year. I think that's my view anyway. By the way, guys, if you haven't yet subscribed or joined Charlie's great trading service, do so. Let me also say that this promotion will end at the end of this year. So if you haven't yet taken it up, I would highly suggest do it today as you're watching this video. So what you can do is go on this link, charlieburtontrading.com/LT Gold, apply the promo code LT Gold, and that drops the price down to £1, which is about $1.30 approximately. And again, do it today as you're watching this video because this promotion ends at the end of this year. Charlie, can give us an idea of what people can get in your trading service, in your gold level membership?
I'm an ex 5 times trading champion as well. And so I've got a bit of history. I've been trading 27 years. And the online trading room that I have, I'm there 5 days a week. And we do sessions throughout the day. And what I'm looking for a lot of the time is big risk reward ratio opportunities. So risking this amount to make this amount. So that's what I'm doing. And that's what I'm showing people what I'm doing with my funds that I manage. And so they can look at all the techniques that I use and they can either do exactly the types of analysis and these big risk reward ratio opportunity trades that I'm looking for, or they can take that, and I've got members who are using it on much shorter time frames and they're trading off of 4-hour charts or even intraday as well, using the same techniques that I use, but just for what's personal for them. So that's what we're doing there. It's a great community of traders with all sorts of levels of experience. I have people with less than a year of experience, but I also have people with over 30 years of experience in my room as well.
That's great. Yeah, guys, by all means, check it out. Take it for a test drive. I think you'll greatly benefit from it. So the link is right there for you guys. It's in the description. charlieburtontrading.com/LT Gold. Apply the promo code on the page. That drops the price down for you to £1 or indeed $1.30 approximately. Thank you very much, Charlie. Cheers.